before we get into the midterm. All right, so because tonight we're just going to really be dealing with using Excel to solve the problems at hand. So what you guys have kind of pushed through with questions 1 through 4 on Tasha is pretty much exactly what you're going to see on the midterm. Okay, like literally all of these variables in the exact order, nothing changed, except you're going to see different numbers. All right. So as we've talked about getting your Excel file set up and getting it properly formatted and getting things linked back to your assumptions table, Tasha is kind of preparing you for what you're going to see on the midterm. Okay. As we're going through tonight, if you've got questions, please just hit the chat room and I will address every question as they come in. From some of the questions that I've received over the last week, it's for the most part pretty clear that you have a good understanding of the content, all right, and how data flows from the income statement to the balance sheet. Where I think some of the hangup is coming is just utilizing Excel as the tool to make the most efficient use of your time. All right. So what I wanted to start with tonight is, does anybody have any questions specifically related to a problem that you may have encountered when dealing with questions 1 through 4 of the case?
I had a question. Was there no like accounts receivable or accounts payable, or was that something that we had to calculate?
So good question, Mike. And that actually is kind of a twist in the case, right? I never gave you specifically accounts receivable or accounts payable, but I did give you days sales outstanding, and I did give you days payable outstanding, right? So if we think back to ratio analysis and we look at how we went about calculating days payable outstanding, it was 365 divided by the accounts payable turnover. And accounts payable turnover was cost of goods sold divided by accounts payable, right? So you have COGS, you have days payable outstanding, you've got 365 days during the year. And so you needed to be able to kind of back solve for the actual value of accounts payable and accounts receivable through the ratio analysis. Does that make sense?
Yes.
Okay. So when we do that, all right, I'm just going to show you the income statement here, or the balance sheet. We can start with that, whichever one you guys would prefer. We have sales, we have the cost of goods sold directly from the case, we have the operating expenses, we have EBITDA, we're told what depreciation is, we're given the interest, we're given that the tax rate is 21%, so we know that the taxes are equal to 21% times our EBT, which leads us to net income of EBT minus taxes. Did everybody get 2020 okay through net income? If not, that's totally fine. Just hit the chat room or speak up and we can walk through where you may have made the mistake. Okay. Once we get to net income, right now we have that management decision that we have to decide on whether or not we're going to pay dividends to shareholders or keep it all for ourselves. Well, up in the assumptions table, it tells us that we've decided to pay out 40% of our net income to shareholders. So we take 40%, our payout ratio, we multiply that times our net income, and we get the amount that we pay out to our shareholders in the form of dividends. And then whatever's left over, net income minus dividends, is kind of what we kept for ourselves for 2020, right? From our operations. We're going to get to 2021 in just a second, though. Okay, we'll finish out 2020. So was everybody able to successfully kind of work through the 2020 income statement based upon all of the data that you were provided in the assumptions table? Okay, I'll put this out on Moodle with values only after we're done for tonight, so you'll be able to go back and kind of check to make sure that all your numbers line up. So then we move from the income statement to the balance sheet. So in the assumptions table, we not only have income statement related items, we also have balance sheet related items. We have things like long-term debt. We have days payable outstanding, days sales outstanding. We're told what the ending 2019 retained earnings were, cash, NFA, inventory turnover. So we need to figure out how do we utilize the balance sheet items to start building the 2020 balance sheet, right? So cash was given. Who was able to successfully calculate $25,000 for as accounts receivable? And if you did get that number, tell me how you got it and tell your classmates how you came about that. Anybody?
Yeah.
Can anybody calculate 25,000?
Yeah, Professor.
Yeah, go ahead.
Yeah. So I used the days sales outstanding of
Yep.
7.3. Then I think I did 365 divided by 7.3, which gave
Yep.
me the receivable turnover.
Yep.
Then wait, I'm just gonna look it up. I did the sales divided by the turnover.
Exactly. So you took sales and you divided it by the denominator that you just calculated, 365 divided by the days sales outstanding. It's exactly correct. Okay. So you're utilizing the financial ratio analysis that we talked about last week and the week before that to determine what the AR is. Right. So you're definitely going to have to understand how that math works when you get to the midterm, right? So accounts receivable was exactly like Liam said, where we took sales and we divided it by 365 over the days sales outstanding. And if you go back to the slides related to the ratio analysis, you'll see accounts receivable turnover and you'll see days sales outstanding. And you'll see the variables that are involved with that: sales, accounts receivable, and the turnover ratio. Okay, so you'll be able to solve for accounts receivable. So just like Liam said with AR, we can do the same thing with accounts payable. Okay, where we're given the number of days payable outstanding, and we need to solve for accounts payable using the exact same formula. Except this time we're using cost of goods sold instead of sales, right? So accounts payable utilizes cost of goods sold instead of sales, right? Because we're talking about what we're buying from our suppliers that goes into the product that we're making, okay? Which is why we use cost of goods instead of the sales revenue. And then we're using days payable outstanding. How long is it taking us to pay our bills to our suppliers? Okay. And then you're given what notes payable is, you're given what long-term debt is, you're given what common stock is. Now, how do we determine what the retained earnings are for 2020? What are we given in the assumptions table that we can use in addition to what we created from our 2020 income statement in order to determine what our 2020 retained earnings are going to look like.
The 2019 retained earnings.
Okay, so that's a good starting point, right? Because we start 2020 with what we ended 2019 with. Exactly like Mike said, we're starting with whatever we ended 2019 with, and then we need to add something to that. What do we need to add to that?
The retained earnings from the income statement.
Exactly, Max. So we take, all right, the retained earnings that we're given in the case, that's what we started with, and we add to that what we put into retained earnings after we made that management decision to pay money out to shareholders in the form of a dividend. Okay, that gives us our 2020 retained earnings. Okay, is everybody crystal on that? If you're not, just speak up. Don't be embarrassed. Just speak up and we'll walk through it again.
I had the right number, but for that, like, would you just make a cell that says your previous year's retained earnings and then just have it like coded that it adds your addition to retained earnings plus that?
Yeah, so when we get to the 2021 estimate, that's exactly what we're going to do. Okay, but for the purposes of figuring 2020 out, like, you're not given 2019 at all, right? The only thing you're given about 2019 is what the retained earnings were for 2019. But when we get to the 2021 estimate, that's exactly what we're going to do, Ron. Okay, equals the year prior plus the addition to retained earnings for that year. Okay. So when we do all the math, we can see we're balanced on both sides. So our balance sheet is correct. So we're done with the income statement and we're done with the balance sheet for 2020. Right? So that kind of answers question number 1 for Tasha. Okay, we built the 2 financial statements with the data that we were provided within the assumptions table. Okay, so you can 100% guarantee yourself that question 1 is exactly going to be question 1 on the midterm. And the data assumption table that you see here for Tasha is going to be exactly the way that it's listed right here, just with different numbers. Okay. So question 2, build the 2021 estimate pro forma using the growth assumption. So in the case, it tells us our growth rate is 10%. So now our job is to take the income statement and the balance sheet and appropriately apply the 10% growth rate to those line items that specifically vary with sales, like we talked about last week. Okay. So starting with the income statement, our 2021 estimate, obviously we're growing sales, so it adjusts with the growth rate. So our 2021 estimate, our projection for next year, in the case of Tasha, is simply whatever she did in 2020 multiplied by 1 plus our growth rate. Okay, she is projecting to do 10% more revenue next year than she did this year. Now, why do we put the dollar signs around the growth rate? Anybody remember?
Because we wanted to use that growth rate every time.
Because we want to use that growth rate every single time. We don't want that. We don't want to copy and paste this formula and have that 10% cell moving around all over the spreadsheet. We want to lock it down so that it's always using that 10% growth rate. So the double dollar signs, Daniel, is that what you were going to say? Excellent. We lock it down. So now we can copy and paste this formula wherever we want, right? So we know that we're going to reference the year prior. All right. So that's why we don't put any dollar signs around K39 here, but we fix it to 1 plus the growth rate. So now I can copy and paste special formulas, every single thing that needs to vary with sales on both the income statement and the balance sheet. So on the income statement, in addition to sales, obviously, what other items vary directly with the growth rate of sales?
Cost
There's
of
three
goods
of them.
sold.
Cost of goods sold,
SG&A.
SG&A,
Depreciation.
and depreciation, right? Because we're operating under the assumption that our business is already at full capacity. We can't squeeze another piece of plastic off of her assembly line to produce the toys that she's making. So we're gonna have to purchase new fixed assets. Okay, so sales varies naturally. COGS, SG&A, and depreciation all vary with sales. Now, we get down to the interest. And we haven't quite decided what we're going to do with how we're going to finance the project, right? So interest is going to stay the same. So interest is just going to be equal to the year prior. We do not vary interest. Okay. We might vary interest once we get to the point where we have to decide how we're going to finance the growth. But for the first pass, interest is the same. Okay. And then some of you will have copied and pasted that 1 plus the growth rate formula into your taxes. That's a classic boo-boo. Okay, classic boo-boo. You cannot just simply grow the taxes by the growth rate. And the reason why is because you kept interest constant, right? You grew everything above it, but interest remained the same. And therefore you can't grow the tax rate by 5%. You have to use the tax rate itself. So do the actual formula, okay? Tax rate, all right? Tax rate times EBT. So you're given a tax rate in your assumption table. Use the tax rate times EBT. Do not grow the tax rate by 1 plus the growth rate. You will make a boo-boo. It's not a huge boo-boo. It's not, it depends upon what the interest number is, but it's not going to be correct. And that gets us to our projected net income. And then using the same payout ratio from our assumptions table, okay, we get the dividends that were paid out, and then 1 minus that is our retained earnings. So net income minus dividends gives us the addition to retained earnings estimated for 2021. Anybody get all of this correct? Megan, how you doing?
Good.
Yep, you following okay?
Mhm.
Okay. So that completes our estimate for 2021 on the income statement. We took the growth rate that we were given in our assumptions table. We applied it to sales, naturally, cost of goods, SG&A, depreciation. We kept interest flat. Taxes were based on our tax rate times EBT, net income, EBT minus taxes. Now, inevitably, there will be some of you that forget what I said, and you will try to change this tax rate and adjust it by 1 plus the growth rate. I'm going to say it again. Don't do it. Use the tax rate times EBT. And then we got down to the dividends that we paid in the addition to retained earnings. Now, if you set your formula up right, where we did the year prior times 1 plus the tax, 1 plus the growth rate, all we had to do was copy that, right? And we could apply it every single other place. And on the income statement, it was only 3 other places. In the balance sheet, what else varies with sales on the balance sheet? Just shout it out or hit the chat room.
Cash,
All right.
AR, inventory,
So we can select that, we can select that, we can select that,
net fixed assets,
we can select that,
accounts payable.
we can select that. And that's kind of it, right? That's the only thing we can really do formulaically to kind of utilize what we've already put in and use Excel most efficiently. And we can copy, paste special formulas, and bam, we're done. All right, so now we've got 3 items from the income statement, and we've got 5 items from the balance sheet that are done in a fraction of a second. Okay, so everything on the asset side varies with sales. AP on the right-hand side varies with sales, but we kept notes payable flat. We kept long-term debt flat because those are management choices, right? We don't quite know how out of balance we are. And we haven't decided yet whether or not we want to use debt or we want to use equity to plug the gap. Okay, so we're going to keep our financing decisions neutral. So notes payable stays the same as it was the year before. Long-term debt stays the same as what it was the year before. Common stock, our equity stays the same as it was the year before. Now, how do we get to this retained earnings value? How do we get the retained earnings for our 2021 estimate? Daniel, you got this? Okay. Oliver, how do we get this number, 488,797 for retained earnings?
Would you take the estimated addition to retained earnings for 2021 and then add it to the 2020 retained earnings?
That's exactly right. Okay, that's exactly right. We start the year off with what we ended the year at, the 333,562, right? And we had some estimate of operations that we were going to do, right? You spent time figuring out some 2021 operations, and then you used that payout ratio to determine the dividends, and whatever was left was shoved into retained earnings. So you started the year off with 333,562, and you added to that what you brought in from your estimated addition to retained earnings, right? So Oliver is exactly right. You start the year off in retained earnings with what you ended the prior year at, then you did some sort of operational activity through your income statement, which shoved some amount of addition to retained earnings into your balance sheet. And that's the starting point, okay? Which gives us an out of balance situation, right? We have assets of 907,500, and we have liabilities and owner equity now of 981,879, which leads us into the conversation that you guys in this class are getting insight into that your other students are not getting, right? How we go about forecasting and how do we plug the hole in our balance sheet through the external financing needed, right? How much are we out of balance? So the difference between our estimated assets and our estimated total liabilities and owner equity is $74,379. That's how much we're out of balance. And then the case tells us, how do we handle the EFN? Where do we plug it? Right? In the case, it tells us plug long-term debt and common stock with 50% of the EFN each. So we take the EFN, we split it in half, we plug this number to long-term debt, we take the exact same number and we plug it to common stock, and now we are in balance.
When
Any
I
questions?
tried to plug that number into long-term debt and common stock, like Excel kept giving me an error.
What kind of error did you get?
It
A
kept,
circular reference?
yeah,
So that's why we have an out of balance section and we have an imbalance section. If you try, like right now, if I went and I tried to go ahead and do that, like if I wanted to take equals that, right? And I want to back out half of the EFN, this is probably what you did. And I'm going to hit enter. I'm going to get a circular reference error. Because my EFN is calculated using all of this data. Right? So now I'm going to get this circular reference error because I'm trying to reference something. I don't know why it's still there. It shouldn't be there unless it should not be there. Well, it's not a circular reference anymore. I don't know why Excel's not clearing all of that. But apparently it's not. So there's no more circular reference. There we go. Okay. Right, because your EFN is calculated, right, Ron, using all of this data. So you can't really reference back to a calculation within a calculation. That's how you get the circular reference. Okay. So what you could do, but what I'd like for you to do is just create a separate balance sheet underneath it, right? And then you can reference back to above it without the circular reference causing a problem. Okay, so in this case, I'm essentially taking what happened up here in long-term debt, and I'm backing out the half of the EFN. Does that make sense?
yeah. So you just like copied the balance sheet from above and then pasted it underneath.
Yep, exactly. Exactly. And as when you get outside of the walls of academia, right, and you're in your job, you already understand that you can simplify the way that I'm doing this into kind of one step if you wanted to. The reason why I do it this stepwise way is to kind of just show you how the process actually works. And then once you get comfortable with it, then you'll be able to just do this without the circular references going forward. Okay. So on the midterm, you're literally like your submission is all of that. Your job will be to fill in everything that you see right here. Right. So day one, you're going to have to give me an income statement for 2 years. You're going to have to calculate the CFFA both ways. You're going to give me an out of balance balance sheet with the EFN and half the EFN. And then you're going to give me an imbalance balance sheet, plugging the variables that you were asked to plug. And your literal like deliverable is to PDF and print and PDF and upload exactly this.
When you're
Any
plugging, yeah,
Go
when
ahead.
you're plugging in half of the EFN, which values do you plug it into?
So you're going to be told that. So in the case, right, I told you in the case in question 3 to plug long-term debt and common stock with half the EFN each.
Okay, thank you.
Okay, so on the midterm, I might say plug notes payable by 25% of the EFN, plug long-term debt by 50% of the EFN, and plug common stock by the remaining 25%. But I'll tell you exactly what to plug, okay? Any questions? Go ahead,
Sorry,
Seth.
so you subtracted the half of the EFN from the common stock?
Right, yes, because we needed, so look, if we look at our out of balance sheet, right? We got 907,500 on the asset side, and we've got 981,879. So we need to bring down the right-hand side of the balance sheet by 74,379. Okay, so when we plug the balance sheet, we know that half that is this, and so therefore, if you've been told to plug long-term debt and common stock, you know long-term debt has to come down by half of the EFN, and common stock has to come down by half of the EFN to bring the entire right-hand side of the balance sheet down by the total EFN. Does that make sense, Ryan?
Yeah, it does. Thanks.
Okay, Seth, what was your question?
Yeah, can you just go over that formula for calculating the inventory on the asset side of the balance sheet? I got the accounts receivable and accounts payable.
Oh, the inventory? Yeah,
Yeah.
sure. So the inventory was, we looked at the cost of goods sold, right? And we just simply divided it by the inventory turnover. Okay. So we got our total annual expense for cost of goods sold for all of the product that we sold during that given year, right? And we know from the case that we turn that cost of goods sold over 12 times. So if we just take the total value of the COGS and we divide it by the turnover, that gives us the value of inventory on the balance sheet. Because then if we think about it the opposite direction, if we look at the value of the inventory on the balance sheet of 50,000, right? And we know that we turn that number over 12 times. 50,000 times 12 gives us 600,000. Does that make sense? If you think about it from the other direction. All right, any question getting to kind of to this point? Because what you guys did for questions 1 through 4, getting you essentially to this final imbalance balance sheet, utilizing the EFN, utilizing the percentage of sales method to calculate what variables change with a sales growth rate, and then forecasting your income statement, and then finally calculating the CFFA for each method. That's the first part of your midterm. Okay. And I'm telling you right now that what you see right here will be in the exact same order, just with different numbers. So if you set your Excel file up properly, it'll simply be nothing more than putting in different numbers. And if you do it right, once you put in the new numbers, your income statement will automatically update. Your balance sheet will automatically update. Your EFN will automatically update. And then all you have to do is figure out what the case is asking you to do with how to handle the EFN to finalize the last piece, and then you're done. So if you set your Excel file up properly, you'll be done with the first part of the midterm in 30 minutes, max max 30 minutes. Any questions on like mechanics of how to use Excel to accomplish what we've just done?
I just have a quick question about the in-balance balance sheet versus the out of balance one.
Okay.
So when you copy and paste it, do you have to fix any of the values, or should it just work and reference the same things?
So what I did, okay, and everyone's going to kind of utilize Excel the way that they are most comfortable. But what I did was I simply copied all of this, okay, and I just pasted it right down here. And then I linked everything back to the out of balance. Okay, so you can see I'm referencing the out of balance. I'm referencing the out of balance. I'm referencing the out of balance. And then what I did was I simply took and the out of balance minus half of the EFN. Okay, now if I really wanted to get a little bit more error proof, I probably should not have hard coded half of my EFN, right? I probably should have just simply referenced that, right? I should have just linked the cell back. I get the same number, but now everything kind of flows without me having to remember that, hey, I hard coded long-term debt. Same thing with common stock. I probably should not have hard coded it, and I should have just simply linked back to half of the EFN. Does that make sense, Megan?
Yes, thank you.
I have a question.
Somebody
So
else had a question. Yeah, Jacob, go ahead.
if I only have an imbalance sheet and I did the EFN a little differently so that it doesn't have that like circular error, will I get points off on the midterm for not having an out of balance sheet? Or
All right, so let me just show you. Let me just show you what it looks like. I'll just show you what the deliverable is, okay? So that everybody can kind of see it. So like this is your deliverable. Okay, so for day one, like this was last semester's midterm. Okay, same thing, just exactly what you've seen from doing Tasha. Okay, and on the first part of the midterm, I literally give you this entire page with obviously no numbers. Okay, and then all you have to do is print as PDF and then upload this page as your day one. So everything's already set for you. You're given the format that it needs to be put in. Okay, and it is literally exactly what I just showed you. We haven't talked about ROA, ROE, IGR, SDR in Tasha's yet, but we're going to get to that. But you've got the income statement, you've got an out of balance projection, you've got an EFN, you've got an imbalance projection, and then you've got this additional question that you have to answer. Okay, so like I'm going to give you exactly the format that needs to be uploaded for the midterm. So you don't have to worry about that. Does that answer your question, Jacob?
yeah, I got it.
But the point is that you're going to have to go through kind of this stepwise process, right? Create the income statement, create an out of balance, find the EFN, create an imbalance, and then that way everything is 5 by 5. Okay. Anybody have any questions before we move on? Okay. All right. So that took care of questions 1 through 4. So basically questions 1 through 4, like that's the first part of your midterm deliverable. Adam's got a question here. Can I go over how to get accounts receivable again? Sure can. Okay, when we look at accounts receivable. So Adam, I'm going to ask you this question directly. When we look at the assumptions table that we've got, what variable in the assumptions table deals with accounts receivable?
Days sales outstanding.
Days sales outstanding, exactly. Okay, because that's telling us how many days it's taking us to collect our money, right? And if we're talking about collecting money, we're talking about collecting cash, conversion to cash, and that relates specifically to accounts receivable. Okay, so days sales outstanding is, if you look back at the slide deck on ratio analysis, 365 divided by the receivables turnover. Okay, and receivables turnover is equal to sales divided by accounts receivable. So we can go into on a piece of paper, right? And we can put both of those formulas down and we can derive a formula that gives us the value of accounts receivable, because we've got sales, we've got 365, we've got days sales outstanding. Therefore, the only other variable involved that we don't have is AR. So we can then solve for accounts receivable. So when we look at the formula, right, it's simply nothing other than sales divided by 365 over DSO. And if you write it down on a piece of paper, you'll see that's how to get it. That's how accounts receivable works. Does that help you answer your question?
Yes, it does. Thank you.
Great. All right, so the only thing that I might change in this assumptions table is I may not give you like revenue, but I might give you profit margin and net income, right? And then you can use ratio analysis to solve for sales, right? Because profit margin is net income divided by sales, right? So you can solve for sales if you needed to. Okay, I haven't decided if I'm going to be that big of an a-hole on the midterm yet. Okay. All right, so any questions about 1 through 4 before we move on to what is going to be like the second deliverable for the midterm and how we go about forecasting the incremental value add from a project that we might be looking at evaluating and implementing. Because once we get to question 5, which is what we're going to talk about tonight, okay, we're just really talking about forecasting for the entire firm as a whole. Question 5 deals with forecasting the value added from a specific project. So it's incremental. We're not looking at the full value of the firm. We're looking at the value that a project delivers to the firm. Any questions before we move on?
For the CFFA, do you have like that code in your Excel to calculate that?
Yep. Everything's coded. Everything is coded. Now, I'm just a bit of a nerd, so like obviously I could also just do it really simply, like equals that minus that, right? And if it's 0, then I know it balances, but I just felt the need to build this nested if statement. Whatever. Again, nerd. Okay. So everything is coded. Everything is coded, because guess what? If you know, let's just see if I can't minimize this a little bit. I know it's going to be a little hard to see, but if I want to change the growth rate, right? So on the midterm, I could say, the growth rate is 5%. If I change this to 5, every single thing that's tied to growth rate is automatically going to change. So watch. Income statement changes, balance sheet changes, EFN changes. I'm still balanced down here in my final projection. I've got a new EFN. I've got a new half of the EFN, still plugs long-term debt and common stock. But if you've built your Excel file right, it doesn't matter what numbers I give you in here. It's going to flow. Okay. Does that make sense? You guys, like seriously, there's like 5 sections of this class. You guys are getting some knowledge, like high level knowledge that the other, what would that even be? 100+ students in the other sections are not getting, because we're utilizing a tool that is incredibly valuable for this kind of work. Okay. I mean, if you guys want me to just put everything on Connect and go that route, we could do it, but you would not get the same experience that you're getting with this. All right. You're learning how to use an amazingly powerful tool to help with your finance. Okay. Any questions before we move on to question 5? Okay. All right, let's move on to question 5. So last week we talked about future value, present value, streams of cash flows, and how we bring those dollars back into today's dollars. So let me just open up a different file here. Okay. And purely in the context of what's called capital budgeting, where departments will go and they will ask the Treasury Department or the CFO for money. I need money to implement this project. And this project that I'm thinking about implementing is going to deliver some value to the firm in the form of free cash flow, operating cash flow. And we could derive operating cash flow from what kinds of ways can we derive operating cash flow? First of all, who remembers what operating cash flow is calculated as? What is operating cash flow? Anybody? Colleen, Nick, Kirsten, Cormac, Seth.
Is it EBITDA subtracted by taxes?
Okay, EBITDA minus taxes. Very good. Or alternatively, all right, EBIT, add back depreciation minus taxes, but congratulations, you learned the faster way to do it, EBITDA minus taxes. Okay, operating cash flow. So when we think about how projects might add value to the firm, okay, we can add value starting from the top line by increasing sales, right? We can add value by reducing cost of goods sold from renegotiating supplier contracts. We could add value by eliminating operating expenses, maybe making our IT systems more efficient. Okay. Anything we do to either increase sales or offset cost, right, gives us a higher operating cash flow because EBITDA will be higher. Okay. So operating cash flow is kind of like the starting point for how we measure free cash flow. Now, come take my Emerging Leaders 703 class, or if you go and you work for a few years and you come take my 703 class within the PMBA program, we'll go into a different methodology for free cash flow. But for this course, we're going to use operating cash flow as our free cash flow. All right, so EBITDA minus taxes. Right, so you're going to go to your CFO, your treasurer, and you're going to say, I need you to give me $1,000 this year. I need you to give me $1,000 right now in today's dollars, right? And if you do that, I'm going to implement this project that is going to deliver some future free cash flow, operating cash flow at a given point in time down the road. right? So maybe your project in year one delivers $300 of cash flow. In year two, it's $200. Maybe in year three, it's $400. And in year four, it drops down to $100. Whatever it is, your project is delivering some future stream of cash flow in return for the company giving your project $1,000 today. And if you remember from what we talked about last week, a dollar today is not a dollar tomorrow, and a dollar tomorrow is not a dollar today. So we have some required rate of return, right? Which we call the discount rate. All right, the DR, the discount rate, which is the rate that says, all right, here's the deal, Clarence, you want $1,000 of my company's money that we've had to work really hard to generate. And as managers, we've determined this capital structure between debt and equity. And we're currently earning 10% on our money. So if you want me to give you $1,000 for your project, then at a minimum, your project needs to deliver to me 10%. Because that's where I've got my money right now. So if you want me to move my money, then at a minimum, you need to earn me at least 10%. That's the discount rate. That's the WACC, the weighted average cost of capital. And after the midterm, like that's our next progression, getting into how do we figure out what the weighted average cost of capital is for a firm. Point being, the Treasury Department is going to tell you, hey, for your project, you need to deliver at a minimum 10%. Okay. Otherwise, why am I going to go up, take my time to move my money from where it's currently invested, debt and equity, into your project? You at least need to meet the 10% threshold, hurdle rate. So, okay. So we think back to the future value, present value calculation. All right. And we look at, we said the future value is equal to the present value times 1 plus the required rate of return to the exponent of the time frame we're talking about, right? So when we think about how to calculate the present value, because that's what we care about, we need to take all of these future dollars and we need to convert those into present value dollars, because we're trying to compare the value of all these future cash flows with what we're asking the company to spend today. So it's got to be apples to apples. So then we said, we rearranged that present value, future value formula to present value is equal to future value divided by 1 plus the rate to the time frame, right? And then we took it one step further and we split out the two components and we said present value is equal to future value times this 1 over 1 plus the rate to the time frame, which was the discount factor, right? Everybody remember that from last week? So if we've got operating cash flow, which is essentially AKA future values, right? And we're going to try to get down here to present values. What do we need to determine? What do we have to figure out? Present value is equal to future value times discount. Alana?
Time. To the right.
Times discount factor, right? And discount factor includes time, the time frame that you're in, and includes the discount rate, right? So let me I haven't done this before, but I'd like to try it. Looking for my little Apple Pencil here. I apologize. Give me 30 seconds. I'm going to run and grab my Apple Pencil real quick. All right, let's see if this will work for me. Okay. Screen mirroring. Can you guys see that? Can you guys see my iPad screen?
Yes, we can.
All right. So you can see that. Oh, this is cool. Okay. So we talked about the future
1
value.
second. It popped up to say like screen mirroring and having like select device, but we can't see if you're drawing something now.
You can't see it now. Oh, hold on a second.
Now we can see it.
Okay. So remember we said future value is equal to present value times 1 plus my rate to the time, right? So the future value is what we saw with the operating cash flows, right? Those are the future values. So what we want to try to figure out is what are my present values? What is the value of that year 3 future cash flow, but in today's dollars? So how much am I willing to pay, today for that future cash flow? So I want to know what the present value is at that point in time in the future. So we just simply rearranged everything and we said PV is equal to FV divided by 1 plus my rate to the time, right? We just rearranged the formula, that's it. Okay, but then we took it one step further to simplify things because we want to know at what rate am I discounting all of those future values at for each period of time in the future. Because now we're dealing with multiple cash flows. And so we split this out into FV times 1 over 1 plus my rate to the time. Okay. And we called this the discount factor. Right? So we're going to go back to Excel here in a second, but what we said was we've got those future cash flows, right? We've got those 4 years of cash flows. Those are the future values. And we know the discount rate, which is 10%. That's what we were given. And we know the time frame that each of those cash flows occurs in, whether it's year 0, so right now, or a year from now, 2 years, 3 years, 4 years from now. So we know the time. So we can calculate the discount factor for every single year. Okay. And when we do that, we can then calculate the present value for some given time frame as the future value in that some given time frame times the discount factor for that same time period. Does that make sense? All right, let's head back. Let's head back to Excel. That was pretty cool. Not as much of a boomer as I thought I was. Okay, back to Excel. Everybody see this okay? Okay, cool.
Yeah.
All right, so now we've got the, you're asking the company for money. Your project is going to deliver some future stream of cash flows. We're kind of getting to how much am I willing to pay for this $400 future cash flow, given my 10% required rate of return? How much am I willing to pay for that $400 3 years from now? That's what we're kind of getting at. So what do we need? If our ultimate goal is to get to that present value, right, for each of these time frames, then I need to take my future value times what?
Times the discount factor.
Times the discount factor. Thank you, Ron. Okay, so now we just need to calculate the discount factor, which was nothing more than equals 1 divided by 1 plus my rate raised to the time frame that I'm in. Right? Now, what do I need to do with my rate if I want to be able just to make my life super simple so I can drag this formula to the rate? Daniel.
The dollar signs.
I gotta shove the dollar signs in there because that fixes that cell, right? It doesn't allow it to move as I drag this formula. So I've just fixed it. It's always going to be 10%. But when I drag it, my time frame is going to change. So now my discount factor, remember, now my discount factor, the time frame related to my discount factor is going to float based upon how I drag the formula. So now out here in year 3, I'm still referencing 1 divided by 1 plus my discount rate, except now my exponent is year 3 because that's the year I care about. So now what we're saying is in year 3, at a 10% required rate of return, right? My discount factor, and this is why I wanted you to calculate the discount factor separately, is saying, thinking back to that present value formula, present value is equal to future value times discount factor. Okay. The present value of this $400 is only worth, in today's dollars, 75.13% of the future value. Okay, so the present value is always equal to the future value times the discount factor. Okay. So how much are you willing to pay? So if I were to offer you right now, listen, Liam, I'm going to give you $100 4 years from now at your required rate of return of 10%. How much are you going to be willing to pay me today for that deal?
$68.30.
$68.30 right there. Because that is the present value of receiving $100 4 years from now at a 10% required rate of return. And if I'm going to give you $300 a year from now, you'd be willing to pay me $272.73. That's how much that investment is worth today. Yeah, Max.
I'm still having a hard time putting the dollar signs on a Mac. Do you know how to do that?
Function F4.
All right, thank you.
You got it. On a PC, it's usually just F4, and on a Mac, it's usually function F4. I'm a Mac guy too. I wish they could standardize some of those things, but hey, it is what it is. So now the question becomes, now that we have converted all of these future values, right, into present values, we can now answer the question. Max, you still have a question?
No, I'm good.
Okay, I saw the little the yellow hand up. All right, now we get to answer the question: is this project worth doing? Remember, you're asking me, the CFO, for $1,000, and I'm telling you that we've got that $1,000 kind of currently invested in something that's giving us 10%, right? So if your project can deliver more value than the 10%, then I'll give you the $1,000 because it's delivering more value to the firm. Remember, increase shareholder wealth, right? That's the goal. I'll give you the $1,000 if your project delivers more than where my money is currently invested. And we call that the net present value. All right, NPV, which is nothing more than the sum of all of the present values. Okay, so we have this cash outflow of $1,000 today that the project is requiring. And in return for the $1,000 of cash outflow, the project will deliver some stream of future values that we're going to bring back into today's dollars at the required rate of return. And so in the case of this little example, we actually have negative net present value. Okay, so the project present values only $807. Jacob, what you got?
So I'm following along in Excel, but my like discount factors are like all off, and I think I have the like equation wrong. Could you quick go over that again?
Sure, discount factor, right? When we were just on, the little tablet, future value times 1 divided by 1 plus the rate raised to the time frame. Okay, so we got 1 divided by 1 plus my rate, which is fixed, okay? Because we don't want that to change. That's not going to vary. Raised to the time period that I'm in. And then once you've got that, then you can just click and drag.
All right, I got it. Thank you.
Yep, no worries. Okay, so what is this telling us? All right, well, there's a couple things. We're taking a future stream of cash flows and we're using the required rate of return to bring those future cash flows back into today's dollars. And if those streams of cash flows do not offset what we're asking the firm for, then our money is better left where it's currently invested, right? So if the NPV is less than 0, we don't do the project, okay? Because at the same rate of return, my $1,000 is better left sitting in the capital structure that we've decided for our firm. Okay, now, if all of a sudden we change this to, we change the stream of cash flows and the NPV goes positive, then the project is delivering more value to the firm in the form of 80 extra dollars, then if that $1,000 had been left in the investment earning 10%, we're delivering $80 of incremental value to the firm when our NPV is positive. Okay, so when we talk about the decision-making process around which project do we choose or not choose, the decision-making criteria is net present value. If NPV is greater than 0, we do the project. Because when the NPV is greater than 0, because we've used the required rate of return and we've summed up all of the present values, if the NPV is positive, we are delivering more value to the firm than would otherwise be had if we had left this $1,000 in the current investments that only delivered 10%. Does that make sense? And again, this is being recorded, so you'll be able to go back and review this. But when the NPV is positive, because we are risk adjusting all of the numbers and we're bringing future value dollars into today's dollars using that required return, we can now compare the value added of the project versus what we're asking from the firm, and in relation to where those funds are currently invested. So when the NPV is greater than 0, we're delivering more value to the firm than where the assets are currently being invested, and therefore we do the project.
I have a question.
Yeah.
So if the NPV is like 0, like it doesn't change, would we do the project or just leave it?
Okay, if the NPV is 0 or close to 0, right, either on the positive side or the negative side, all right, keep in mind that it's very rare that companies, firms are only evaluating one singular project to do, right? You're talking, depending upon the size of the company, hundreds, if not thousands of projects that are being evaluated every single year for the finance department to allocate capital to fund those projects, okay? So in general, what happens is all of these projects get shoved through the capital budgeting process with net present values listed, and then they'll get sorted. Which projects deliver the highest net present value all the way down to the ones that deliver no net present value, right? So if you're only dealing with 2 projects and they're both 0 net present value, maybe you just don't do either one. Maybe you just take the easy route and keep your money invested where it's at. It's kind of up to you at that point. But there has to be a number at which you start to think about doing the project. And that's why the NPV of 0 or greater than 0 is kind of that threshold. Okay, because anything more than 0 is technically better than where you've got your money invested. But if it's close to 0, you may choose just to not do it. You know what I mean?
In a case like that, would you also look at like what's kind of like safer, or which one like you'd be more likely to get that return or something, or is that return normally like kind of conservative to make sure you get it?
All right, so that's a good question, Adam, and that's going to lead us into kind of this next segment of tonight where we get into question 5 of Tasha. So you could have, right, 2 projects that carry 2 different discount rates. All right, discount rate is kind of representative of the level of risk that the project entails, right? The higher risk, the higher the discount rate. If you want me to give you money, but you're asking me to give you money for a high risk project, well, guess what? I'm going to require you to give me a higher rate of return. I want to be compensated for that level of risk that I'm taking, right? So the higher the risk, the higher the reward. So maybe you've got project one that's got a discount rate of 15%, so it's a lot higher risk. And maybe you've got project two that is a very low risk and might carry a discount rate of 7%. Okay, and when we do the math, both projects may come up with a net present value of 0, right? Or call it maybe $100. So it's positive net present value. But the risk appetite of the board of directors might suggest that, all right, like we get that the net present value is positive, but there's just a lot more risk with project one than project two. So we're going to go ahead and do project two, okay, over project one, because we just really don't like the high level of risk with project one. Does that make sense? So there are cases, and we're going to talk about it once we get into question 5 with Tasha, where you kind of have to ask yourself that second question. Net present value is positive when I'm evaluating two projects, right? Maybe net present values are exactly equal to one another. But maybe you're just, as a firm, you're not ready to take that next level of risk for that second project than you were for the first project. Okay, that's a management conversation that gets had every single year on every project that gets submitted to the capital budgeting board. We good? Okay, so how did we get operating cash flow? You guys told me that it was EBITDA minus taxes, right? So this now leads us into Tasha, where we're now going to forecast 10 years of net income based upon a revenue and capital expenditure growth assumption. Okay, everybody good? Ready to move on? Okay. All right. So, question 5. We've got some marketing campaign that Tasha's looking at. All right. And she's going to project that this marketing campaign is going to increase sales, words matter, incrementally by 6.5% starting in 2022. We're going to assume that Tasha's 2021 projections materialize exactly as projected. So what that means is whatever you forecast for 2021 actually winds up happening exactly like you forecast. And the marketing campaign is expected to support this sales growth for 10 years. Okay. So we're looking at a 10-year projection now. And we're given some assumptions. The project is going to cost $125,000. It's going to add 6.5% to revenue. But the SG&A is only going to move up by 4.5%. All right, so the operating expenses are not going to vary at the same rate as the revenue growth is. Our required rate of return is 10%. We're going to have to purchase some fixed assets for $50,000. And we're told that it's going to depreciate straight line over 10 years. And we're given our tax rate of 21%. So we're going to work with this to start. And then we're going to get to this after we get down to EBIT. Okay, so we're going to build an income statement for this project. Okay, so the first thing that we have to do is I'm just going to copy and paste values, all of this stuff. So give me a second. Okay, so what we're working on now is kind of the second deliverable for the midterm. Okay, once all of you guys submit this data for the first part of the deliverable, okay, I'm going to give you this starting point. I'm going to give you the actual real data, because I don't want, if you've made a mistake on day one, I don't want those to carry through to the second part. Okay, so I'm going to give you a clean start. I'm going to give you the actual data. Okay, so we've got 2021, right? So the case tells us that we're going to go for 10 years with this project. So we got 1 year, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay. Now, if you're a little ADD like I am, like I would fix all the formatting right now so that it kind of looks immediately appealing to me. But if you hold off on doing it, I'm going to show you like a really easy way when we can use the painter. So we highlight everything. Okay, and we double click this format, the painter, I can just simply highlight everything and it will automatically adjust my formats. Okay, just a neat little trick. So the case tells us that we have some sort of sales growth. We have SG&A growth. And we have some discount rate or required rate of return, right? Sales growth was 6.5%, SG&A was 4.5%, and the required rate of return was 10%. Okay. So now we're looking at Tasha's business through the lens of the project. Okay. The project is going to deliver some incremental value added over what the firm did last year. Okay, so when we grew the sales and we grew COGS and we grew SG&A in the first part of our questions, right? We took 1 plus the growth rate because that gives us the total firm value. But now what we care about is project value, the incremental value added that the project is going to deliver. So when we look at 2022 from a sales standpoint, it's going to deliver 6.5% additional sales over what we did last year. So now it's not 1 plus, it's just simply times the growth rate. Okay, so the project is going to add $89,375 in additional value to Tasha's firm. Okay. And now we also know that cost of goods sold varies with sales, so we can do the same thing. Okay. And we know that we've calculated gross margin as equal to sales minus cost of goods sold. Okay, so for the project, so question 5 is all about the project. All right, incremental value the project is going to deliver to the firm. So the project is going to deliver an incremental $46,475 of gross margin to the firm. And then SG&A, we are told, is going to go up by only 4.5%. So not the full 6.5. So SG&A is going up by 4.5%. So equals times 4.5%. Okay. And we have EBITDA, gross margin minus operating expenses. same thing. So now we're delivering an incremental EBITDA of 31,625. Okay. Now, how do I figure out depreciation? What does the case tell us that might give us some insight into the project's requirements for new fixed assets? That's where depreciation comes from, right? Depreciation is derived because of the fact we had to buy assets. The government allows us to depreciate those assets and we get some benefit to that, right? Or from that. So what does the case tell us about depreciation? We're going to need to buy $50,000 of new assets, right? And it tells us straight line depreciation over 10 years. So what does that give us in terms of that line item?
It adds 5,000 per year.
We have 5,000 per year. We get to depreciate $50,000 over 10 years, equally straight line. Okay, this is just taking you back to AC 201. All right. And I'm not going to change this. It's always going to be straight line. I'm not going to get into some maker's table and make you figure all that stuff out. It's going to be whatever that number is divided by 10 years is our depreciation. So equals 50,000 divided by 10, right? That's our depreciation. And EBIT is EBITDA minus depreciation. Okay. I'm going to come back to interest here in just a second. And then I'm just going to fix my formulas here. Equals EBIT minus interest and equals EBT minus taxes. And I'm just going to go ahead and drag that over and drag that over. Okay. Now my taxes, right? I'm going to go ahead and just kind of link it for the sake of linking it. But you guys are going to have that assumptions table from the other file, so you'll be able to keep everything contained. Okay. So our taxes, remember, don't fall into the trap of just growing everything. So it's equals EBT times my tax rate, which I'm going to fix. And then I can now drag it. Okay. But we got to figure out what to do with interest as it relates to the project. Okay. Because in the case, gives us some details around some financing that we're going to have to do. Tells us that we're going to go to the bank and we're going to take out a $50,000 loan as part of the project cost. That loan's going to have a 10-year repayment term at a 3.5% interest rate with annual compounding. Okay. How do I determine the interest rate or how much interest that I'm going to pay on this loan every year? Anybody have an idea? There's no wrong answer in this one, just conversation. How do I determine how much interest I'm going to pay on an annual basis? Some of you might be thinking, well, I just take 3.5% and I multiply it by the 50,000 and that's going to be my interest. But remember, we're talking about a loan. So when you take out a mortgage on your house, you have to amortize that loan and you pay more interest up front than you do on the back end. And you also pay less principal up front and more principal on the back end. So the longer you're continuing to pay on your loan, the less interest that you pay and the more principal you begin to pay down. So what we have to figure out is, what's my payment going to be, which is principal plus interest, right? Because your monthly payment on your car or your house doesn't change every year. right? You pay the same amount every year on a fixed rate mortgage or fixed rate car loan. But how much is going towards interest and principal will vary. So now we need to figure out, of this financing decision, how much interest am I going to pay in year 1, year 2, 3, 4, 5, all the way out to year 10. And Excel is such a magical tool that it'll actually tell us that with a couple of functions. Okay. So here's our loan data, right? $50,000, 10 years at a 3.5% rate. If we want to know what our annual payment is going to be on this loan, we can use the equals PMT function. Okay, so equals PMT, and we open the parentheses, and it kind of tells us what it wants, right? We can give it the rate. We can give it the number of periods. In this case, it's annual compounding, so it's just 10 years. And we can give it the PV. And there's our annual payment. That's how much we have to pay the bank every year. But that doesn't tell us how much of that $6,012.07 is related to interest, because it's the interest that we get to deduct off of our income statement to lower our tax burden, right? So we need to isolate what portion of that $6,012.07 payment is specifically related to interest. And guess what? Excel has a formula for that too. IPMT, interest payment. So if we look at equals IPMT, again, Excel, just give me what I want. Give me the data that I need to calculate this for you. We have the rate, okay, which I'm going to fix. Now we have this new variable called period. Now it's asking you, what period of your loan are you in, so that I can calculate how much interest you owe me in that specific period, which is also equal to the year of your project. So period 1. I'm not going to fix this cell for a reason that you'll see in just a second. Number of periods. How many total periods? Well, it's 10 years, right? But I'm going to fix it. What's my present value? Same thing, but I'm going to fix it. Right? Now, why did I not fix the period?
Because you don't want it to stay the same.
I want to be able to do I only want to have to create this formula one time. And then I want to be able just to drag it down all the way through the 10 years. So I'm keeping my loan amount, my term, and my rate constant because I got dollar signs around everything. But I want this cell, I want it to move as I drag it down so that it changes the period that I'm in to give me the specific interest associated with each of those periods. And when I do that, it gives me, okay, I'm going to delete this because it's already right here. It now tells me that of this first payment that I make in year 1, of this $6,012.07, I am incurring $1,050 of interest that I'm paying to the bank in that first year. Okay. And then I could also look at the principal if you wanted to, just to double check your math, which instead of IPMT, it's PPMT, principal payment. Okay, and if we add those two up, we can see down here that the sum is $6,012.07, which is exactly the payment that we calculated. So we now know that all of our math kind of works. But this is how we determine the interest that goes into our project valuation. Okay. So in my file, like I've got everything linked up, just equals down here to this table down here, equals as you're going across, so that when I change my terms, the interest will change and my interest here will also change. You could also copy it, right? And here on the interest, because you had the interest going in the rows, now we need to go to columns. We got to transpose it. So we can simply go to pay special, values, transpose. And now I have all of my interest copied out for 10 years. Okay. So you're getting down to EBITDA using the same kind of methodology that we've talked about. We're going to vary sales and COGS with the revenue growth rate. We're going to vary SG&A with whatever you're given for the SG&A growth rate. We're going to get to EBITDA. You're going to create your depreciation, okay, which is just simply the total fixed assets that you're going to be given divided by 10. You're going to create your amortization table so that you can determine what your interest component is using the IPMT function. And now it's really just a matter of clicking and dragging, right? So for 2023, we're going to do the same that we did the prior year. So it's just equals the prior year. Same thing for COGS, equal the prior year. Gross margin, I encourage you, don't do equals the prior year, copy the formula, okay? SG&A, same thing as the year before. EBITDA, same formula, okay? Depreciation, same as the year before. EBIT, same formula, okay? See where I'm going with this? EBT, same formula. Taxes, same formula. Net income, same formula. Okay, so when you get down to EBIT, everything through EBIT, right, at this point is going to be the same number. And you've referenced the year prior in your formulas. So now all you have to do is just drag it. And you're done. You've just done 10 years in 2 seconds. Okay, your EBT, you can just drag the formula, right? Because you've created it such that it is EBIT minus the interest that you've already put in there. Done. Taxes, same thing. You've fixed your tax rate, so 21% of EBT. Done. Net income, EBT minus taxes. Done. And technically, we're not even going to use these guys. So I'm just going to get rid of those. So what have you just done? What have you just accomplished? Well, you've just accomplished creating a 10-year pro forma for the value add for the project that Tasha is considering implementing. So we went from this example, right? We're asking for money. The project delivers these future cash flows. We went just on a 4-year basis to a 10-year basis. So if you look at kind of what we did earlier, what's the next most logical step that we need to do? If we've got net income and we've got all these other financial components, what's the first thing that we have to figure out from a calculation standpoint? I just gave you a big hint.
Operating cash flow.
We got to figure out operating cash flow, right? We got to figure out, well, what is our cash flow, because we need to then convert that into present value dollars, right? So operating cash flow, AKA FVs, right? If our project is going to get put in 2022, right? And we're going to start delivering value from our project in 2022. We had to spend some money in 2021 to get the project up and running. So just like in this example, we were asking the firm for money in year 0, 2021 is kind of like our year 0, right? So how much are we asking from our firm in the case of Tasha to get this project up and running? What does the case tell us?
$125,000.
Thank you, Nick. The case tells us the project is going to cost $125,000. So it's going to cost us $125,000 in 2021, right? If we spend this money, then we get this incremental net income, right? So now we got to figure out what our operating cash flows are, our future values for the project, which, as you guys already told me, was EBITDA minus taxes. And once we have the first year, we've got every year, right? Now that we've got all of our future values, what's the next step in the process? Remember, our ultimate goal is to get to net present value, which means we have to convert all these to present values, and we're going to convert all of these to present values. We have to take the future values and multiply it by what?
Discount factor.
The discount factor, right? So we now need to calculate the discount factor. And we said the discount factor is equal to 1 divided by 1 plus my rate, discount rate, which we're obviously going to fix because it's going to stay the same. And we want to be able to drag this and make our life a hell of a lot more efficient than having to do this in each cell. Okay. Now, with all of the Excel wizardry that I have imparted upon you, how do I create the next part of this equation so that I can use the years to my advantage to get me to the time period that I'm in? Remember, it's not just raised to the exponent of 2021. It's raised to the exponent of the time period that I'm referencing. So what formula can I shove in right now in parentheses that will allow me to do this one time and then drag it out for 10 years? That will give me 0, 1, 2, 3, 4 as my exponent, right? Because that's what we're looking for. It's the time frame of reference. So I'm going to open this up. Anybody have any ideas? How do I make 2021 0 in the eyes of Excel?
Minus 2021.
Okay, so I could do the year minus the year, right? That gives me 0, which gives me a base year. But now I want to be able to drag this. And if I drag it, it's going to give me 0 every single place that I drag it. So I always want to reference my base year to give me something minus my base year. So how do I fix my base year?
You do the dollar sign for the first year.
Right? So now when I drag it, now I'm taking the year that I'm in minus my base year that I've fixed. So every time I drag this, it's always taking the year that I'm in minus my base year, which is giving me the time frame that I need for the exponent in my discount factor. Does that make sense? Okay. And now I can drag it all the way out. Because now even out here, I'm taking 2027 minus my base year, which is giving me 6, which is giving me 1 divided by 1 plus my rate to that time frame that I'm in. Right, I'm 6 years out from where I'm at today. And once I have my discount factor, now what can I do?
Calculate the present value.
Now we can figure out present values, right? Present value equals future value times discount factor. Future value times discount factor. Do it one time, click and drag, right? And now we can calculate net present value as equal to the sum of all of the present values and we come up with a positive number for Tasha's project. Okay, so do we do this project or not?
Yeah,
And if we do it, why do we do it? Why? Why are we making that decision?
because it's going to generate 36,442 in dollars in today's money.
Adding on to what you just said, it's going to deliver $36,443 of money above and beyond where we currently have that $125,000 invested within our capital structure from a debt and equity standpoint. Okay, so we're adding value to the firm because the net present value is greater than 0. This project delivers more dollars of value over the 10-year life of the project than we would otherwise get if we kept the $125,000 invested where it currently is sitting. Does that make sense? Because we have this discount rate of 10%. Our required rate of return is 10%. And so if we're bringing all of these future dollars into today's dollars using that required rate of return, then if all of those future positive cash flows from the project offset the money that we're asking for, then the project is delivering more value to the firm than that money would otherwise deliver had it stayed where it was at. Does that make sense? Clear? It's an important concept. Otherwise, if it's negative, I'll keep the money where it's at. I'll earn more money if I just leave the $125,000 earning 10%. We're risk adjusting and discounting those future cash flows at that required rate of return. And so therefore, if the sum of everything is positive, then we're delivering more value to the firm, which is what our goal is. Does that make sense? Okay. So this leads us to the final conversation for the evening. and it's about what's called the internal rate of return. Okay. It's the rate of return that forces the net present value to zero. Okay. So IRR, internal rate of return. And it is that discount rate, weighted average cost of capital, required rate of return, that creates a zero net present value. And we'll talk about why that's important here in just a second. So if we're trying to determine what discount rate is needed in order to set net present value dollars to zero, then we need to use the undiscounted future values, right? If we use the discounted future values, we're already accounting for some level of discounting, and we're trying to then solve for a discount rate. So if we're trying to solve for a discount rate, we need to use the undiscounted future values. So Excel can do this for you by simply typing in equals IRR, okay, and choosing your undiscounted future values. Okay, so using these undiscounted future values and using the IRR function, Excel is going to come back and say, this is the discount rate that would force the net present value to be zero. Okay, remember last week when we went through and we did kind of the goal seek? And I was showing you the fast way to adjust your dividend payout ratio to force the EFN to zero. Right? We could do the same thing here. So the internal rate of return, if our required rate of return was 16%, then our net present value would be $0. Okay, so our spread, this is important, our spread to WACC is equal to our internal rate of return minus our discount rate. And next week, we'll get into why this particular variable is so important. Okay, but what you need to know for tonight is the internal rate of return is the required rate of return that is needed in order to set the net present value to zero. Okay, so if we did the goal seek like we did last week, where we want to set our net present value to zero, we can go to data, we can go out here to what if analysis, we can go to goal seek, we can set the net present value to zero, and we're going to vary the discount rate in order to do that. Okay. Learn, if you set your Excel, one of the things that I hope that you come away from this class with is learning how to set your Excel files up properly and linking everything. So that you only have to make a couple of changes, because I will tell you right now that goal seek is one of the most magical functions within Excel, right? So I want to set the net present value to zero, and I want to vary my discount rate, because if you remember, the discount rate flows into the discount factor, which then flows into the PVs, which then flows into net present value. So Excel is going to just change the discount rate until the net present value goes to zero. And if our IRR calculation is correct of 16%, and IRR is representative of the discount rate that is necessary in order to set the net present value to zero, then by doing the goal seek on the discount rate, I dang well better get the same number, right? My IRR and my goal seek discount rate better be the same number, because the entire purpose of the IRR is to figure out what discount rate is required to have $0 of NPV. So let's see if it works. So I'm going to set B31, which is my NPV, to 0, and I'm going to vary my discount rate. Bingo. Okay. So now we've just proven that the IRR that's necessary to set my NPV to 0 is 16%. Okay. And our spread to WACC, our spread to the discount rate, is the IRR minus the discount rate that we're given. And again, we use these terminologies kind of interchangeably: required rate of return, weighted average cost of capital, WACC, discount rate. They are all representative of the same thing. If you're going to ask me for my money, you're going to ask me for the firm's money, then this is my required rate of return if I'm going to give you the money to implement your project. Okay. Questions? So we're going to stop here in terms of like the knowledge bomb for tonight. But if you want to talk more about Excel mechanics and how to use Excel to your benefit, and like how did we get certain numbers on this sheet, now's the time to kind of just ask the follow-up questions for everything we've talked about. Next week, we'll get into profitability index. We'll get into payback period, things like that. But this is the extent of tonight's kind of knowledge.
I got a question.
Go ahead.
Yeah, so how did you get all the interests into the income statement? Like, how did you paste all of them?
Sure. All right. This is also just kind of Excel. So I've got this, amortization table, if you will, here. Okay. We've got 10 years, and I calculated what the interest payment for each of those years was going to be, right?
Yeah.
And once I got that, I simply took all of the data and I copied it, right? And I went over to the file that I was working in. I selected the first year. Paste special. Values. And then this is what you have to click, transpose. So transpose will take something that's in a column and convert it to a row, or vice versa. I could take a row and convert it to a column by simply selecting the transpose. Okay. Now, in your Excel file that you're going to be building, all right, so like this is my master file for Tasha. Okay, so everything that you see here is kind of like my master file for the Tasha case. And what we just went through, right? That's what this is. So you could, if you wanted to, do what I did. And that is, I just simply linked that cell down to my first year. I linked my second year down to my second year. Okay, so you've got a couple of different options as to how you want to do it. Linking it saves you a step. You don't have to pay special transpose, but in how we were doing it, I needed to do it that way.
Thank you.
Sure. Again, by the end of this semester, you guys are going to be Excel wizards, and every single other person who is in the other sections of this class right now is not getting what you're getting. What are the questions? So in all seriousness, y'all, like, this is the midterm. All right. What you see with Tasha, this is the midterm with just different numbers. All right. My philosophy is I want to try to teach you the right way to do it. And I want to build each week upon each week, just like I told you from the very first lecture, right? We're going to build every week to get to the midterm. Next week, we're going to add a next level of learning about when do we get paid back from our investment? How many years is it going to take us to get paid back from that initial investment that we put out there, right? When in this stream of cash flows, okay, do I get paid back? Right? Because I'm out 125. And then I've got 24,000 of present value, but I'm still in negative territory. Still negative, still negative, still negative, still negative, still negative. And then finally out here in 2028, I wind up having a positive present value. Okay, but what part of 2028? We're going to talk about that next week. Okay, it's called the payback time frame, right? And we've got NPV and IRR and spreads, right? So next week we will finish our conversation around getting you 100% prepared for the midterm, right? And I promise you this, what you see here is 99% of what you're going to see on the midterm. So if you get your Excel file set up for this, you will be done with, you'll be done with the first part of the midterm in less than a half an hour. And you'll be done with the second part of the midterm in less than 20 minutes. Okay. If you get your Excel file set up properly. Questions? If you want to hook up offline to go through Excel, if you want a little bit more knowledge about Excel, feel free to reach out to me. I'm more than happy to hook up on Zoom with you. I'm more than happy to spend time with you. Okay. I appreciate everybody's flexibility with being virtual tonight, but I figured it was probably a good idea to go ahead and just get this particular lecture recorded so that you can have time to go back and look at some of the things that we've just worked through, as opposed to trying to, remember it from your notes. All right, so with that said, I'm going to go ahead and stop the recording and just answer any questions that, you guys have.